afternoon and welcome to Unlock the Stock. As you know, this platform is created for retail investors to connect with corporate management and to gain a better understanding of them and their companies. Unlock the Stock is sponsored by Easy Equities, the platform that helps you to grow and protect your wealth, where you can invest in local and international shares, property, unit trusts, cryptos, bonds, and actively managed ETFs. Plus, you get access to Easy Protect life insurance and Easy Credit lending to back your financial journey. We're pleased to welcome Southern Sun to Unlock the Stock, and today we're joined by the CEO, Marcel van Ouwelok, who will be taking you through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to discover more about their various online AGM and investor presentation solutions. Today's Q&A session, as usual, will be hosted by the Finance Ghost and Mark Tobin of Coffee Microcaps. Before we start, there are just a few housekeeping notes. The presentation will be followed by a Q&A session. You can post your questions by typing them into the chat box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You will see an email address when we begin the Q&A session. Please take note of this if you want to be added to Southern Sun's investor distribution list. Marcel, that's all I have to do for my introduction, and I am ready for you to share your screen and take us through the presentation, please.
Okay, let's see if I get this right here. Share. There we go. Okay, thank you very much. Make sure this is working. All right. Yeah, thanks for this opportunity. It's interesting because of Easy Equities. We have a very large shareholder base. We've got something like 21,000 shareholders, and I think probably close to 19 or 20,000 of them are through the Easy Equities platform or are retail shareholders. They don't own a large portion of the company. We're ultimately controlled by HCR, but these are people who've taken an interest in us and have put some of their savings in us. So we thought this was a nice opportunity to do a presentation that explains a little bit more about what Southern Sun is, rather than just be a number crunching results presentation. We have a lot of data on our website. We do keep all our presentations, all our investor presentations. We do there both results, interim and finals, plus what we do at investor conferences and that. So the sort of nitty-gritty detail of going through financials and so on, you can find there, but that really isn't what we're aiming at today. But maybe just more education on what Southern Sun is. It's a brand I think South Africans know, but they don't really understand what the group consists of. So we'll try to give you a bit more insight into that today. I'll start with, I guess, where we came from. If you looked at the Sunday Times top 100 list recently, like half the stocks in the top were not the normal massive growth stocks and so on. They're the ones that were in the biggest trouble 5 years ago when COVID hit. And we've got the little picture there of what our GM Wayne at the time did at Elangeni Maharani. And it was obviously I think for the tourism industry, it was like a total shutdown. It was something that could never be foreseen. We had hotels where the doors don't actually lock because they've never been closed. And we had to close 100 properties over the course of 3 days. But what it did give us was quite a lot of learnings. And I think at some stage there was Martin Wiest, who's quite a good friend of mine at Turvest. He had a great saying. He said we were a startup company with 50 years experience. So COVID is kind of day zero at everything we look at, because it almost doesn't matter what we did before that. We changed the company fundamentally then. We totally restructured the cost base, how we operate. We went through a restructure that you couldn't do if you didn't shut down the whole business. You could never afford to take those kind of actions. So as much as it was a very traumatic time for the business and for people in general, it did have a silver lining in how we could just totally relook at our business model. We cleaned up our cost base. We had a complicated dual listing structure at the time, with Southern Sun owning the majority of a propco that was listed as a REIT. People will remember the Hospitality Property Fund. We cleaned that up by swapping up into one class of shares. So we came out of it a lot cleaner and a lot more understandable. And we sold some assets that were very valuable but didn't actually make any money for us. So we had a super luxury hotel in Seychelles, 30 rooms, and we owned half of that, and we sold that for, our share was I think $30 million. So in total, you were looking at more than $1 million a key. We sold our property in Nigeria, and all of that was to cover losses that we incurred during COVID and also reduce debt. So the difference of this business pre and post COVID is pretty fundamental, and we've done sort of 3 lines there that matter. In F20, which was the last period just before as COVID hit, we'd had an occupancy of 59%. Last year we had 60.8. Now that's not that different; it's only 1.5 percentage points different, but our profitability changed fundamentally. We went from 26 cents a share to 75 cents a share. Now, if we increase occupancy by another 1.5%, etc., you are going to get good growth in earnings, but you're not going to get that kind of growth. And that just talks to the cost structure and the whole re-engineering of the business that we did. And then fundamentally, we got rid of the debt. So we went from a 3.3 billion debt level down to virtually no debt at the end of March 25. And we've given guidance that by the end of March 26, we'll probably be in a cash position. Unless we do an acquisition or something, we won't have any debt. So this business is just fundamentally different to what it was when we unbundled from Southern Sun, which at that stage was a casino and hotel business. And we did that in June 19. So with this new business that we've restructured and so on, what have we got? And my biggest argument for Southern Sun is that you've got an absolutely irreplaceable set of hotels. If I gave you 30 or 40 billion rand in 10 years, you couldn't rebuild what we have. The locations don't exist. The replacement cost of this infrastructure is just enormously expensive. We've got fantastic distribution across all your key city nodes, Cape Town, Sandton, Durban Beachfront, uMhlanga Rocks. It's pretty hard to move around largely anywhere in a major city environment and you will not see our Sunburst logo. We pretty much dominate downtown Sandton, or the Sandton Mile here with the convention center and Sandton Sun and so on. Same on the beachfront and the city bowl in Cape Town. As you come off the highways where the convention center is a large number of Southern Sun hotels, and those sites don't exist. And the ability to build this kind of infrastructure out would be very, very difficult to replicate. We've got great brands. Our chain brands are Southern Sun, Garden Courts, SunSquares, and StayEasys and SUN1s, which go from sort of 4-star down to 1-star, pretty well distributed across the whole country. So we're able to service customers in virtually every town. And then our 5-star hotels are individually branded. So I've used the Beverly Hills there, but we've got Arabella, we've got 54 on Bath. We don't have a 5-star chain. We tend to think that 5 stars need a more personality type thing. So we individually brand those properties. And then we're very big in the conference and exhibition market. So we operate the Sandton Convention Center. We also own Birchwood, which we haven't branded as part of us. It's run by the founding family of it, but Birchwood is ours. I see some noise on Twitter every now and again about who owns it. And on top of all of that, we also own some of the most profitable hotels that operate under the international brands. And that was a result of the hospitality fund acquisition that we did. So the Westin in Cape Town is ours, which is a big 5-star property on the CTICC. And we own 2 Radissons. The Radisson Gautrain belongs to us, and we own the majority share in the Radisson Collection at the waterfront, which is a truly stunning property. And we operate the Intercontinental at the airport. So that's A, they're good properties, and B, they give us great insight into how the big chains in the world work. So we're pretty confident that we haven't fallen behind anywhere, and there's no trick we're missing because we are generally their largest owners in the country. So exposure to hotels, to tourism, to conferencing, pretty much Southern Sun's it. There's nobody else that's got the range of exposure that we offer. And now this thing isn't moving. No, there we go. Because of the work we did during COVID, we've also got a very strong balance sheet. So our cash flows are strong. We are spending a lot on CapEx now, and I'll talk quite a bit in this presentation about why we're doing that. But we are very cash generative, and we've got no debt, which gives you great balance sheet capacity. So we have the ability to do acquisitions quite quickly. We can effect on them. In the property world, they're generally quite highly geared, high loan to value ratios, and then tap into the equity market, which can often be dilutory to shareholders. We don't have that sort of property focus on it. As much as we are a hotel property owning company, we will use our balance sheet, and we buy back shares more than ever issue shares. That operational gearing and that cash flow gives us the ability to grow earnings very nicely if we just get a little bit of decent top line growth. And that's what we've been seeing recently. And I think Finance Ghost has alluded to it with City Lodge's numbers lately. We don't really know what's come through. Obviously, big events like G20 and so on have helped, but there's a demand in the hotel industry at the moment that we haven't seen for quite a while. And we think that's on the back of just all the things in South Africa being, if not great, certainly a little bit less bad, off the grey list, interest rates coming down, inflation going at 3%, which is, it's painful to get there, but I think it is a great thing. There's a sense of slight optimism in the SA economy. So if we can grow occupancy, which we are experiencing at the moment, your flow through to the bottom line is fantastic because you have such a large fixed cost base. And we recently in our half-year results put out the stat that got us by surprise. Our occupancies in South Africa was 74.8% or something. And it was the highest occupancies, or the first time that we had exceeded the June 2010 World Cup month. So it's been 15 years since we've had countrywide occupancies at that height. And it's quite important because we're a big group, so we've got a lot of rooms. We can't have a spike in occupancy just by doing well in one region. Everybody knows Cape Town's doing well. Everybody knows there's a lot of a boom in Cape Town. But for us to get to 75%, we've got to do well in Cape Town, Durban, Joburg, all nodes of Joburg, and I'll talk to Joburg in a moment, but it's a big market, and all your outlying areas. You can't have weakness anywhere, otherwise your average gets dragged down. So that was quite a key stat for us. And then October was good, and then November was a great month too, but it was buoyed obviously by G20. But there does seem to be an underlying demand in hotels at the moment that we're pretty happy about. One of the things in COVID was everyone thought the dead end of hotels, which I guess is why anything to do with travel and tourism was so hammered in COVID, was that nobody's going to come back. You're going to have everything happening online, which to some extent is true. I mean, something like today is online and has a very broad reach. I guess a decade ago, you would have tried to do a presentation in the convention center and hope people would make the effort to go there. But we've seen a very strong demand for conferences, for exhibitions. Post-COVID, travel has become one of the go-to things that happened worldwide. And not just the business travel conference type of world, the leisure travel boomed dramatically. So I think the game lodges in South Africa, for example, had an absolute boom time. They got rates they never thought they would get before. And international travel pulled back or improved very strongly. There are some barriers to that, such as flight capacity and flight pricing and so on, which affects long-haul destinations like South Africa. But certainly a world 5 years ago, if you said to people that we're going to be doing 3 times the pricing in Cape Town that we'd achieved before, and volumes much higher than we'd achieved for several years before COVID, people would have said you're mad, and that hasn't been the case. People want to travel. We have strong relationships with all the channels to bring those people in. Travel management companies, destination management companies. We've been working very hard with the OTAs. You know, they're a bit of a love-hate relationship. They can dominate you and you try to dominate them, but certainly companies like Booking.com and Expedia are very key to the modern bringing business into hotels. And we have our own very active sales force that has good relationships with corporates, government departments, conference organizers and so on to drive that business into our hotels. If I just talk at a glance, we've got 16,942 rooms, so just under 17,000 rooms and 95 hotels. Obviously, your big nodes are going to be Joburg, Durban, and Cape Town. Gauteng will be the biggest number of rooms, but quite spread out. I mean, people forget just how big Joburg is. When you're talking Gauteng, it's the entire Pretoria market. The airport node is a very active node. Sandton itself is the obvious answer, plus Rosebank just down the road from here, right out to the Vaal River, Vereniging and so on. So it's still the economic heartland of South Africa, and that's why you have a larger room exposure here. But then we are distributed around the country. So we've got in every province and all the major towns. And then we have a reduced Africa portfolio because we sold Nigeria and one of the Seychelles hotels, but we still have a very beautiful hotel in Pralin in the Seychelles. We are the biggest operator in Mozambique with 500 rooms, which also tells you how small that market is, that 500 can make you the biggest. A couple of hotels in Zambia, one in Tanzania, one in Abu Dhabi. And then we've got some hotels that are managed by the third-party operators. I alluded to it earlier. The Western in Cape Town is operated by Marriott, the 2 Radissons, and we've partnered with Echo Motels For those of you that take the Gautrain, you'd have seen the Echo Motel in Midrand, not in Midrand, at the Marlborough off-ramp. They're very good at that budget level. So we've got a couple of hotels that we've given them to run for us. And it gives you an idea of our portfolio. We do cover just about everything. So I'll talk to our brands in a second, but we've got 300 conference venues, banqueting facilities, we've got restaurants, we've got bars, and we do just on 1.7 billion a year in food and beverage revenue. So we cover the entire market, with the exception of, I guess, really luxury in bush lodges, is about the only part of the market that we are not involved in. The brands, as I said, the people will know: Southern Sun, Garden Court, StayEasy, SunSquare are the common ones, the sort of city urban ones. Categorized at full service, economy, and budget, but in general, these are 4-star, 3-star, 2-star, and 1-star. And then our 5-star brands, as I said, are individually branded, where you try to create a more distinctive personality in the property than you would in a chain. Although I still believe chain hotels do not need to be boring cookie cutter hotels. The interesting thing about a hotel is its competitor set. Generally, if you stand on its roof, you can see it. So you compete with the hotels directly next to you. You have to be in your node, and each building has its own personality. So even if you've got a chain on it, you can try and give it a personality and a life. It gets harder as you go down the scale. Obviously, customers want value for money more than at the top end. But hotels are different to other buildings. They have a personality, and that personality needs to shine through. When you start talking about hotels, if I'm at a dinner party or anything like that, I mean, people's mind obviously immediately goes to holidays. And it doesn't help that I started my presentation with a picture of the beach in Seychelles, because that's exactly what people think about holidays, or about hotels, that it's all to do with holidays. But in truth, a hotel is a little bit like a dam. If you want to fill it, you've got to have every pipe pouring water into it. We cover and service just about every segment of the market you can imagine. We've got business, government, groups, conferencing. MICE is the meeting and incentive business. And a question I often get, for example, is what is your split between business travel and leisure travel? And it's not as simple as saying, well, the travel during the week must be business and the weekend will be leisure. If you take something like the Springboks that we are the hosts of, if you've got a Saturday test in Durban and I've got the Springboks in Beverly Hills and I've got Italy or Ireland or somebody in the Garden Court up the road, and I've got the media in Elangeni, all of those people are working. That is their job. That's what they do, is professional sport. That for us is business travel. Obviously, the supporters that come along and just going to watch the game, that's leisure. Churches are often a business. Airlines are a business. So the concept of hotels just being leisure is you have to cater to every last thing. Clearly, some places like Seychelles will be purely leisure. There's absolutely no one goes to Seychelles for a conference, but the vast majority of our properties service just every aspect of this market that you can imagine. Right down to, we get it like really good December business in Sandton, which is outlying people coming into the city for Christmas shopping and so on, and it's leisure. So it's a city-based, normally business type hotel, and it picks up a whole lot of leisure over a holiday season because of Christmas shopping and visiting friends and family. And every one of our rooms expires every night, so you've got an expiring stock. A hotel with 100 rooms has got 36,500 room nights available. You've got to try to sell every one. So you have to tap into every possible market you can. And once people understand that, I think they look at hotels a little bit differently, and why we chase every last little node. The other interesting thing about it is that we're a business where nothing is material, which makes everything material. I think if you were to spend 20 million with us, you'd be a top 10 corporate client, but that's out of 7 billion turnover. It's lots and lots of little transactions, which means every single transaction is absolutely important. We don't go sign a billion rand deal with a single customer. So it's an interesting business, and it's a pretty sexy business to be in. What is our strategy? Well, our strategy is a little bit inward focused, which means don't lose the good things that we did in the COVID period. Don't let old bad habits creep back into the business. Keep ourselves lean and mean. We have an operating philosophy of being consistent, being present, and having respect, which applies across the whole group. And it basically means be a decent person. You'll find if someone is consistent, being present is listening to you. There's nothing worse than whether it's a waiter you can hear is just on autopilot, or you're talking to a receptionist, or you're talking to the ops director, and they're not paying attention to you. You realize they're not present. They're listening to you to answer, not to actually take what you're saying, and generally show respect. These are traits that we find give us a definite advantage in the market in our service. And the one compliment I get all the time is our people. They are truly special at what they do. We have a great corporate culture, and it feeds through to the guests, and the guests love our people. So that's a very important part of what we do, and we focus on the guest a lot. To get the guest in, you've got to have a relationship with the entire industry. 65% of our business is direct to us. So somebody has walked in the front door and said, I'd like a room. They've phoned or they've sent an email, and the balance comes through all the channels, and you've got to work with the channels, your OTAs, your industry partners. But ultimately, once you've got a guest, if you treat them right, they become very sticky. They don't, you don't lose them easily. On our capital allocation side, we invest a lot, still an inward focus. We're investing a lot in our properties. If I go back to what I said at the start of this, if I gave you 40 billion rand, you couldn't replace what we have. So we feel upgrading our product, making sure they stay best in class, is definitely the way to spend money. We can get more out of our existing product by upgrading that than chasing new build. So we'll only build where we think there is real new demand coming, and it's important for our portfolio. We won't just build for scale. So that's quite different to the internationals who don't invest in product. They just have a marketing branding system. For them, number of units is everything. How many contracts did you sign this year? How many new hotels have you signed up to your system? We're not that way. We don't measure ourselves by saying we've got 95 hotels, let's see if we can get to 200. We think we can get a lot more out of our existing properties, and that's where we come with this idea of an inward focus. And we've also returned a lot of cash to shareholders in the post-COVID years through share buybacks and through dividends. Particularly share buybacks, while we were so deeply undervalued, were very lucrative for us. There's only 2 slides on numbers, so I'll talk a little bit, but it gives a feel of what those 5 years have been like. So the blue block on the left-hand side is kind of what this business was when we unbundled from Soho. We were generating cash of about 1.2 billion, and then we hit the red blocks in the next 2 years. I mean, the mastery of unbundling a little hotel business from a big casino business 6 months before COVID will never quite be explained, but anyway. And then COVID came along, and you can see the losses we made. In the first year, we lost close to 500 million, and we made up for that by selling that hotel in Maya, which covered our first year's losses. And by the second year, it wasn't happy days, F22, but it was at least turning positive. There's still a lot of uncertainty in the market, but we were able to wash our face and keep ourselves above water. And then the recovery came through, and you can see how the earnings have just grown over the last few years. And last year we did a cash flow from operations of just under 1.9 billion, and that's still at that 60.8% occupancy. And we think our medium-term occupancy should rise. Whether we get to 65, 68, I'm not sure, but we're certainly aiming in the short term for 63 and north of that. So you can see the cash flow generation start performing very well as those occupancies come up. Our maintenance capex, we obviously cut back dramatically during COVID, but we did maintain still. So anything that broke, we fixed, and we looked after the properties, but we weren't doing upgrades and renovations and system changes and so on. And that you have seen accelerate in F24 and F25, where we spent 300 million 2 years ago, 450 million last year, and we've been guiding for closer to 650 million this year. And that's with these renovations that I'll talk about in a moment, of upgrading the properties, that we've been putting money back into that. But if you take a sort of period of time, over 3 years here, we can generate, after maintenance capex and so on, 2.5, 3 billion rand. And that's with some recovery in it. If we normalize earnings, we should be generating 5 billion rand over a period, which gives us quite a lot of ammunition to buy back shares, to give money to shareholders, and to do acquisitions if we see something attractive come along. Obviously, that assumes that the current market holds and improves and doesn't fall apart. And there are some risks out there. It is a cyclical business, but we think we're in still growth phase at the moment, rather than sitting at a peak saying, well, how long can this last? We don't feel we're at any sort of peak at the moment. What do we do with that cash flow? So we spent some expansion capex. We bought out some minorities in Birchwood. And then I sold 10% back to them because it's the family who runs it, and they're very good at it. But the big thing we did was we did over 660 million rands worth of share buybacks. We bought back just under 10% of our, just over 10% of our shares, and that was very good for us. I think our average price was R4.80 or something. And that helped our earnings per share improve dramatically. And we started paying dividends. So we've committed to a 1/3 dividend policy. And if all goes well in the next 5 years, I don't think 1/3 will be enough. But you can always adjust your dividend policy or pay special dividends, and buybacks you don't have to give a policy for. You just buy back as soon as you see value in the share. So that's a nice flexibility, I think, that we've kept in our capital structure. And there you can see our debt has come down from the 3.3 billion we started with at the start of COVID down to 266 million at the end of last year, and we think we'll be net cash by the end of this year. So it's a good balance sheet and strong growing cash flows in a relatively muted environment that we hope is improving, and we're seeing signs of improvement rather than declining or stagnating. Move this along. I've gone too far. Sorry. So I've spoken about the refurbs. We are covering a lot of properties, and I don't mean for this to be death by pictures of rooms, but it gives you a feel of the kind of product we've got and where we're spending money, which obviously focuses in the key nodes. And then I'll talk on some of these ones that we've done some big work on, give you a little bit more detail on. But we've covered hotels from Rosebank to Sandton, nearly all our hotels in Sandton. We've done the Gautrain, the Southern Sun Sandton, the Sandton Towers. In Cape Town, we've upgraded the Radisson Blue to a Radisson Collection Hotel on the waterfront. As you can see there, I mean, it does have a spectacular location. The Cullinan was one of the first big refurbs we did post-COVID, and it's been very successful for us. I mean, it is a beautiful hotel. It's one of the most beautiful lobbies in the group. We've done little hotels like Southern Sun Mbombela, which is 109 rooms, but has a very loyal following there. We do a lot of volume through Mbombela, so that's been upgraded. And then the big story in our first half of this year was Seychelles. Seychelles is a very lucrative property. We make good money out of it. It's not a terribly big property. It's only 80 rooms, but we did a complete refurb there that we haven't done in a very long time. So we gutted the rooms completely, new bathrooms, etc. I'll show you some pictures on that. Give you an idea of the type of things we do. In Rosebank, we'd actually done the lobby and so on just pre-COVID, and then everything shut down. But we've gone back in, we've built in new restaurants, we've done the North Tower completely, and we've seen some good volume growth responding to that in what is actually quite a tough node. Rosebank's always been a bit secondary to Sandton, and it's got a lot of stock in it. There's several new hotels that opened that were underway pre-COVID but opened post-COVID, so it's quite overtraded. But we've seen good success by having renovated our property there. Southern Sun Sandton's been a great success. That was a Holiday Inn property under Hospitality Fund. We took over, debranded it, made it into a Southern Sun, and refurbished everything: public areas, restaurant, bedrooms, corridors, the works. And we've seen really good successes. So that hotel's getting great volumes and good rate upside. I think it's by far the best 4-star hotel in Sandton now. It's got a very dedicated following building up to it, and the product came out really, really nicely. So we're pretty chuffed about that one. The Cullinan has also been a great success for us. It's beautifully located right outside the CTICC in Cape Town. We did the whole. It's got, as I say, probably one of the best lobbies that I've seen designed around. It's just got grandeur and scale that makes you feel like you're special when you arrive in a hotel. So we redid the lobby, changed the color schemes, and we've redone all the bedrooms. And it's really done wonderfully for us in the first half of this year. So it's been strong growth in Cape Town out of that. Most people don't believe us when we say it's not a 5-star hotel. I mean, it operates like one, but it was a joy to renovate that property. Consequences, I'm going to have to do the one next door. As soon as you wash one shoe, you've got to wash the other one. The other 5-star hotel we did is Sandton Towers. This wasn't our money. We operate this for a consortium of Liberty and Pareto, but they put in the money. We redid the whole property, 232 rooms, including a pretty magnificent presidential penthouse at the top. And we wanted to get this done before G20. We opened it up in November of last year. We really had planned to do this during COVID, actually, but was a hard time to allocate large cash to that. And this is trading wonderfully. It is a gorgeous building. It's got a beautiful Art Deco lobby, big atrium hotel, so you've got real grandeur in it. So we're very chuffed with that. And then the Radisson Collection, as I said, we converted that from Radisson Blue to Radisson Collection. I've seen good rate uptick from that. And it really is a property that talks to location. It's 177 rooms, sits on the edge of the ocean, on the edge of the V&A. And it's the only Radisson, I think it's the first Radisson Collection in Africa. And we own half of that. So that's been a very nice refurb to do as well. Little hotel, like I said, Southern Sun Ltd. We do a lot of government business there, corporate, sports teams, and we're getting nice volume upside from Nelspruit. And it just shows you, as soon as you put some money into the property, it just reinvigorates it and gets a whole new life. And then my baby, Seychelles. This was a complete gut. New bathrooms, totally new bedrooms. We took the public areas down and rebuilt them on the same platform, but brand new layout. And in our half-year results, we made the point about how much impact it was. Because it's so lucrative, the difference between it being open and closed is about 30 million after tax. And we only make about 300 million in the first half of the year. We make all our money in the second half of the year. So it had quite a big impact in our results. But it opened on the 15th of September, and by October, it traded at over 82% occupancy and a fantastic rate. So the market there has responded really well to it. And it is a spectacular location in the Seychelles. I mean, it's a truly gorgeous place. Future developments, as I said, we're not that keen on just building. So we don't have a target to go out and add 100 hotels to it. But we've got a couple of key projects that we are working on. The first is the Beverly Hills. It's first on here, but it's probably the slowest to do, is the Beverly Hills redevelopment. So Beverly Hills was the start of the group. That was Sol's first hotel in uMhlanga there, and created a JV with SAB that formed Southern Sun in 1969. We own all the land from the Beverly Hills up to the Pearls, for those of you that know what the beachfront of uMhlanga looks like. And we have the ability to expand this hotel. We don't want to make it enormous, so we're going from 90 rooms to about 177, 175 rooms. So it'll still have that boutique feel to it, very much like the Radisson Collection in Cape Town. But we think there's a great market for it, and it's without a doubt the best location in uMhlanga. Redo the swimming pools in the front. The building is 60 years old. So it needs to be done, and there's a lot of planning to get this right. And I, in particular, do not want to destroy what Beverly Hills is. It's got a sense of personality and a dedicated following that we're not going to undo. We want to maintain that. So that's a big project that we're taking slowly. We don't think we'll start spending money for at least another 2 years, but there's a lot of design development work and town planning and so on that has to happen there. Much quicker is the Oceans, Southern Sun Hotel and Residences Oceans. On the Oceans Mall, there are 3 towers there. One is the Radisson on the left. There's a residential tower on the far right, and the middle tower will be us co-investing together with the developers. And that will be a 200-room hotel plus serviced apartments, which is a new thing for us, and some residential in the top of it. So that's under construction at the moment, and we think that opens probably April 27, somewhere around there, if all goes on plan. And then our other big project is in Cape Town. We have great locations in Cape Town. So the picture that you see on the right is a sort of aerial view of downtown. The big block is the Sandton Convention Center, where we own the Western Hotel. Next to it is the Cullinan, and next to that is the Southern Sun Waterfront. So that's 1,500 rooms sitting in that little node. The open square of land outside the Cullinan, directly opposite the convention center, is also owned by us. And the plan there is to build a mixed use of offices, and then a 330-room 5-star hotel with glorious banquet rooms on top, etc. I'll talk to the risk of oversupply in Cape Town in a moment, but we think, one of the best development sites Cape Town's got left. If you take the buildings that show in that picture, the majority of them are owned between ourselves and Growth Point, including the other piece of vacant land to the right of our open site, and that's the Growth Point site. So we're working on them. Norbert's got this concept of precincts, and I think he's absolutely right, where you don't just go and build your building and hope the neighbor does the right thing. You work on a precinct, and between us, we own a lot of those buildings in there. And we want to work on that precinct, that it flows better into the waterfront. And by precinct, you mean the public areas, you do the security, you pedestrianize areas better, you do public artworks and so on. So we're quite excited about that. We are nervous of oversupply coming into Cape Town. There are a lot of hotels announced. We know most of them won't actually get built. But we also don't want to be a cause of our own demise by building too much stock. So we're not looking to build 10 hotels in Cape Town, but we do think these two sites are great for hotel and other mixed-use development on it. And if we can do that in partnership with Growth Point, which is what we're busy with at the moment, I think that'll be a great opportunity for us. So really in our expansion plan, and there are one or two other small ones, we've only got those 3 material projects, of which 2 are really material to us, Cape Town and Beverly Hills. And we'll manage those carefully. And if you think back to what I spoke about, the cash flows, we think we can do all of this out of existing cash. And we might go into debt a little bit, whether you have no debt or you have R1 billion debt on our balance sheet, it's pretty small. But over time, we can effectively fund all of this out of cash. So it doesn't put the group at risk. And managing risk is very key for us. I think COVID taught that to everybody. When you've got leases and COVID comes along, the landlord looks at you blankly and says, like, where's my check? And in the first 3 months of COVID, everyone was kumbaya and we can make plans, but it wasn't going to carry on for 2 or 3 years. So we don't really like leasing. We have renewed our lease for Elangeni, Maharani and Durban, but we've got protections in there that you can't hit a brick wall. And the other properties that we've got that are under leases we'll deal with as we go along. But this group certainly 15 years ago had a lot more leases, and we've eliminated those, either bought them out or got rid of them. So currently our leased properties make up less than 6% of our EBITDA. So if it all goes wrong, it's not a material impact on the business, and that is why we'd rather manage or own as opposed to lease. You make 2 areas of money in hotels. You make the actual profit, the cash that you earn every year, and the other one is that your properties go up in value over time, if you've got the right node and you've got the right operation. If you're leasing, you don't participate in the second one. You only get the first one after paying a big chunk of that profit away in rent. So we'd rather own, or we'll be the manager, but ideally not the lessee. Don't make mistakes. Having come through COVID, having gotten this business into like a really good nick, we don't want to make mistakes, and debt is dangerous. So we use debt very judiciously. One of the things we started when we unbundled from gaming was that we had some $76 million of debt. And now in October, we've just settled the last of any dollar debt that we have. So we're not exposed to foreign currency debt at all. And in fact, within a month or 2, we won't be exposed to any debt at all. But you do have to use it in a business, but you have to use it very carefully. And acquisitions and new builds have very high hurdle rates compared to our own shares. And that's why we've invested so much in share buybacks, because buying another little piece of ourselves is more lucrative than buying somebody else's hotel. There are acquisitions that we look at that we think will be attractive, but that has to be the hurdle. Is it better to buy your hotel or buy some more back of Southern Sun? And new builds are hard to justify because they're expensive compared to historical cost. And certainly if you're doing large-scale developments, you don't want to stop once you're going, because then that's about the worst you can do. And I won't finish off on traumas, but there's an interesting letter we received recently. The guest actually dropped it off at the Beverly Hills. And it shows, I guess, a simpler time. This gentleman had written to the hotel and booked his room, and the general manager wrote back and said, dear sir, with pleasure confirming your double suite for the night of the 26th of May, 1973, bed and breakfast for a charge of 30 Rand. So it was just a simpler time. You didn't have booking.com, you didn't have online things, you didn't have 1,000 rates and so on. You wrote to the hotel and they wrote back to you and said, there you go. What I also then worked out is, I thought, well, how is 30 Rand comparing to today? Because long term, we say hotels can be volatile, but they do, and certainly my experience has been they've grown very nicely over the years. Now, it does mean that you have to have the right product in the right location, because Joburg Sun in downtown Joburg is a terrible example of one that didn't work, but the Beverly Hills is a great location. And that same suite today would cost you about 9,036 Rand. So that's a compound growth rate of just over 11% over some 50 years. And the best I could find on the internet anyway is that compound inflation over that period is about 8%. And I don't think there are too many fund managers that can guarantee you 3% above inflation over 50 years. So yeah, it's a bit of a life hard in this, but it does show this grows over time if you keep your location going. And it's just a great business to be involved in. And that is my story. There's a lot of financial information on our website for those that are interested. And otherwise, we'll have some questions.
Marcel, thank you so much. That was super entertaining. Please don't ever start a finance podcast. I'd prefer not to compete with you. I'd rather listen to you than listen to me. So that was great. Thank you. And I think anyone who's watched all those pictures is now firmly in holiday mode. So you might have sold some extra rooms. If you've got any left, based on recent occupancies, it sounds like the ship has definitely sailed for December, but maybe next year. Anyway, welcome to the platform and to everyone who has logged in this late in the year. It's lovely to have you. So first question from my side, Marcel, and you did a really good job of just showing all the different brands, some of it's luxury, some of it's, you know, slightly more affordable travel, I suppose, conferences, etc., etc. It's always nice, and maybe there isn't an answer to this question, but sometimes it's nice to give investors just something to hang on to say, okay, if I'm going to own Southern Sun, it's because, you know, fill in the blank. Is it inbound travel? Is it local travel? Is it luxe? Is it more affordable? If, like, how would you fill, if there was one way, I mean, it's not your whole exposure, but like the real juice of the business, if you could fill in that blank, what would you say to someone?
I say it's our distribution and the fact that we cover all segments. So in the recent period, the Cape Town story's been the thing that's made us look most clever. The rates there have boomed, the volumes have boomed. Cape Town's got absolutely that global cool city phenomenon, and we happen to have an enormous amount of stock in Cape Town. We're by far the largest owner there, and we've just been in the right place at the right time, and it's done very well for us. But other segments also do well. So at the moment, we're seeing a great run in Sandton and in Joburg, because as this economy seems to be getting a bit of life in it, there's definitely been an uptick in that. Durban's had a big turnaround as the city's addressed the issues of the beachfront. We've got over 80% on the books for Elangeni for the month of December. I haven't seen that for a number of years. The beaches were only closed for 10 days in the last year. Obviously, the media doesn't report that because nothing to report. The beaches are open, which is what they should be. But we cover all of that. And I think our strength is that we are in all segments and we are everywhere. At the same time, we focused on South Africa. So in the global world of hotels, we're a tiny little minnow. We really are small. But in this market, we're the big fish. And we know this market well. And we've covered this market well. And I think that's our single biggest selling point.
Marcel, hi, and thanks for a great presentation. I've kind of got two questions, and they're kind of around occupancy, but so I'm going to combine them into one. Things like the G20, which, you know, we just had, and, you know, if we look the other side of Christmas, just given where resources have been this year, you know, the mining in Daba is coming up in the first week of February in Cape Town. While that is a, you know, an ongoing annual event, I mean, I'm sure there's kind of swings and roundabouts depending on how the resources sector broadly is going. But how do those kind of one-off or annual big events, where, you know, because the mining in Daba is so large, you know, a 10% drop in people who attend actually is quite a big number versus a 10% increase of the number of people who decide to come maybe in February now because of a resort. Like, how does that impact overall group occupancy? Or, as you said in your presentation, all the other little ones contribute, and, you know, G20, yeah, it's great. It's a nice cherry on top, but, you know, it doesn't really impact overall occupancy rates or levels.
That is the short answer. Everything's, you know, nothing's material, so everything's material. Big events like that do have an impact. I mean, G20 was a lot stronger than we thought it would be. And particularly the B20 before G20 was actually the real strength. The number of corporates and foreign businesses that were represented in Sandton here took us by surprise completely. So the week before G20 was where we really shot the lights out. All of those are important, but there's always something. One of the things that's made Cape Town a little bit softer this year than prior years was some of the sporting events haven't happened again, or they've had less participation in them. Now, next year's got a New Zealand full test thing coming. Like that's manna from heaven, because that's going to be popular, and you're going to get a traveling trip with it. A couple of years ago, we had the British and Irish Lions tour, and it didn't work because we weren't allowed to play in the stadiums and so on, and we still had to. But that type of an event really helps South Africa, and there's always one that comes through. We don't hang our hat on any particular event. I referred right at the beginning to we beat the June 2010 occupancy levels of World Cup. Actually, the year F11 was when World Cup was a bad year for us. We only had 58% occupancy year round with a very high World Cup year. So we don't build hotels. We don't think about these individual events. We need all of them to flow in. You will get spikes, but I'd say G20 is no bigger impact than last year when we didn't have an Easter. And Easter is quite bad for us because your business travel dies down. So if your calendar forms with 2 Easters in it, that's probably worse for us than not having a G20. So all of these things are important, and they have to be countrywide to move the needle substantially. The beauty of places like Cape Town, and one of their great successes, is their continuous drive to not only keep the conferences, but to build on them. The CTICC is one of the biggest economic contributors to Cape Town. It's part of the reason the V&A is so successful. It's part of the reason downtown could be fixed so well by the city, because it's kept that activity coming through. And Durban's an example where they lost that, and they're working very hard to try and get that back. Sandton works brilliantly. The convention center here drives a lot of business here. So the answer is you need all of it, and you need all of it all the time. It won't always be the same thing, but there will always be something different to fill it.
Okay.
Yeah, Marcel, all of the sports travel references are super interesting. Obviously, the big Springbok partnership. I noticed your key risk slide didn't have anything in there about rugby players doing some eye gouging in the bar after hours. So hopefully you won't have to worry about any of that. But the conferences stuff does come through strongly, and I'm glad you raised Durban, because that is something I picked up in your recent reporting, that there's a lot happening there to try and improve things. I mean, as you've kind of alluded to there, the success of the conferencing center is also just where it is. It's the precinct mentality that you mentioned, in your engagements with Growth Point, etc. So is that the secret sauce to Durban, is just improve the whole place and the conferencing will get better? Or are there like specific initiatives underway? Are they trying to compete on price? Like what really gets that job done and actually gets that thing into a growth engine mode?
The 2 things. One they have tackled is the infrastructure and the PR, and the fact that the beaches need to be open, and the promenade needs to be safe, and it needs to be clean. They've done a very good job on that, and we're seeing a benefit of that, and that's why I think our December holiday period is looking so strong there. The Durban ICC itself, I think they made a mistake a few years ago moving the Convention Bureau out of it, and they tried to broaden its focus to cover the whole of KZN. And now you're trying to service rural towns, and you're trying to do something for the capture site, and you can't have that. You need a dedicated sales team. The conference business, you're not competing between Joburg, Durban, and Cape Town. You're competing globally. A lot of these could decide tomorrow they're going to Madrid or Barcelona or Las Vegas. And to get into those decisions are made years in advance of the conferences. So you need salespeople, and we have people that go to Vegas, we have people that go to Germany, that go to the big conference organizers events that are booking stuff 3 and 4 years out from now. So if you can't say, well, let's just fix this ICC and let's go and get some bookings. You need a system in place, you need it properly skilled, you need it resourced for bookings that are going to come to you in 2029, 2030. And I think that realization has hit home, and I think there's a lot of work happening there to get back to that, because your competition is not local, your competition is global for that.
Marcel, I just want to do a question on CapEx. I know you talked about CapEx has kind of been on the increase and set to increase again, more of a catch up from COVID than kind of anything else. But if we ignore COVID for a second, in terms of maintenance CapEx and upgrades, and how does that play into running a successful hotel and capital allocation and overall profitability of the asset? If you're wanting to run a successful hotel, how should we think about CapEx? Is it a percentage of revenue every year? Are you on a time scale of every 7 to 10 years we need to do kind of a big kind of refurb of all the rooms and the lobby and everything? That maybe just through like how does maintenance and upgrade decisions are kind of factored into through the cycle running in the hotel?
So we spend somewhere around 550 to 600 million rand a year on CapEx, plus we spend probably 200 million on repairs and maintenance. And it's a bit of a fine line in accounting, which one goes through the income statement as repairs and maintenance, which one's CapEx. But you've got a core, in a hotel business, I say you've got to put between 20 and 25% of your EBITDA back into that business, into the property. And if you're not doing that over a period of time, you're under-investing. Now, I could look like a hero, switch all this CapEx off for 3 years, pump it all out in dividends or buybacks, pump the share price and run. The next person's got a big backlog to deal with then. You've got to continuously maintain these things. The sort of guidelines we give are that your bedrooms, your softs and so on are somewhere around 10 to 12 years. It's accelerating a little bit because of fashions and technology. So just when you've got all the right USB plugs next to your bed, they change the plugs. Now you want a USB, but you can kind of fix those as you go along. But after 10 to 12 years, you'll start getting that feeling of this room looks old. And sometimes it's worn out. That I'm very unsympathetic to, because you can just replace. But it just changes fashions. You know, I've been here long enough that I'm on the second cycle of refurbing some of these hotels, and you walk in and you think, well, who signed that carpet off? And you realize it was you. So you've got to put a bit of thought into that. And then your core infrastructure should last a lot longer, your bathrooms, your MEP, your big plant, but it depends how you maintain it. So if you're not skilled in your maintenance department and you're not diligent on your servicing and maintenance, that stuff's going to catch you a lot quicker. But you probably will do most everything on a hotel within a 25-year cycle. And anybody who's not spending 20 to 25% of their EBITDA on their property over a period of time, can be lumpy and you can delay a year or two, etc., you're probably underinvesting.
I'm still laughing about the carpet joke. That's great. Yeah, I can well imagine that conversation. I wanted to ask you about food and beverage. So, I mean, obviously it's it's City Lodge I'm talking about here. They've done a lot there to kind of grow that in excess of room revenue. Do you believe there's an opportunity for you to do more in something like that? Or is the food and beverage business already mature? And so it kind of just grows with the overarching hotel, as opposed to an initiative you've deliberately had to follow in order to play catch up?
So City Lodge never had any food and beverage. It was founded by Hans Enderle. He was a chef by training, but he vehemently kept food and beverage to an absolute minimum as part of his running that very, very lean structure that was the great success of City Lodge. He said he didn't want to go into food and beverage. That's a strategy they've changed in recent years. So their growth is doing something that they never did. We've had food and beverage for years, and we're on a very different scale there because of the nature of our properties. So I think they do about 20% of their revenue is food and beverage. We're at 25% of it. And a lot of it is breakfast, banqueting, and booze. And that's where we make our money.
Marcel, maybe I can jump in here while we've got time with a question. And you'll love being asked this, because someone in my DMs pointed out that it looks like you're going to be bloated with cash in years to come. So isn't that a nice position to be in? And, may that happen. And I guess the question then is around the potential uses for that cash. And I wanted to put a bit of a tweak on it, which is to say, to what extent does HCI as the mothership and the group structure mean that, dividends are going to be part of that story versus maybe share buybacks, for example, or sitting on cash? I mean, it is a different kind of shareholder register. There is HCI, they do have their own projects. So maybe to the extent you could talk around that and whether or not that impacts the kind of cash decisions we might see in years to come. So
HCI isn't terribly imposing on the business. What we've agreed, and by we is our board, which is largely HCI dominated, is we think a 1/3 dividend policy is good as a policy, and you must stick to that, and you must pay your 1/3 of profits out. Of the 2/3 that we keep back, I like buybacks because it does help your EPS if you do it at the right price going through. So I'm happy to buy back shares. I only have 2 or 3 big projects, and there's not a lot of big other ones that are certainly in the 5-year horizon that we would do. But it keeps you the capacity that if there's an acquisition that comes along, we can write a 1 or 2 billion rand check very quickly. And then you would use that sort of cash to pay that off, chop, and get out. And to the extent you don't find a lucrative acquisition that's better than buying back your own shares, or if you think your share price has run too far and it's not worth buying back, then give the cash back to the shareholders. We did that in the past when we were the gaming company. The only difference between now and in my sort of history, in the long-term history of Southern Sun, was we used to be owned by SAB, who had infinite cash. Then we had, independent of SAB, but we had casinos who were like enormously cash generative. Now we're this little hotel business that's got a high capex, maintenance capex requirement, and is relatively small. We make about 1 billion a year in cash. If you want to go build a 1.5 billion rand hotel, you need to think about it. We don't have an SAB type shareholder who can write a check for us. So we pay out slowly, but we're not going to sit on cash and just make it lazy in the thing. But we don't get undue pressure from HCI. Dividends are not the worst thing to pay. I just think at the moment we can do better out of buybacks.
Yeah, love that. Thank you very much for your time today.
Thank you.
Marcel. Thank you to everyone who chose to spend some time with us today, and a special thank you to Marcel for making the time to support this platform and to engage with your retail shareholders. This concludes Unlock the Stock for 2025. So we are busy organizing our 2026 program. So please watch out for any upcoming invitations. Thank you for listening and for all the insightful questions across the year. And from all of us at Unlock the Stock, we wish you happy holidays and safe travels until next year. That is all from my side. Goodbye.